Freddie, welcome on stage.
Thank you.
Now, you might not realise this, but we do a lot of preparation for these discussions, and we've had a couple of great conversations leading up to this conversation. But Freddie, I think you've got a really unique role and really unique experience in supply chain finance. So I wanted to ask you about setting the scene first. How is supply chain finance sort of evolving? How has it evolved? And is it possible that supply chain finance becomes like a win-win for everyone involved in that system?
Yeah, no, and good afternoon, everyone. Really great to be here. SCF, supply chain finance, has been around for 20 odd years. In fact, JP Morgan just celebrated one of its first confirming programs where it was born in Spain with Acciona. So 20 years is a long time, but it's still evolving. And the good thing about trade, as we were discussing earlier, is trade raison d'etre is only there by continuing to innovate. And supply chain finance is part of that. So, for those in the audience who are not familiar with it, the idea of supply chain finance is to provide early payment to suppliers. And it's meant to be a win-win for both buyers and suppliers. Buyers can maybe look to negotiate extended terms with their suppliers, meanwhile the suppliers get access to liquidity at a lower cost of funds because it gets to leverage the buyer's credit rating. And the buyers are normally of a decent kind of credit standing. But how has it evolved? Well, data analysis is now a big part of that. So the original programs that were put in place, they maybe only went after the larger suppliers and they were relatively small, but they were fine for the more strategic ones. But as they become more mature, we now need the data analysis to figure out, okay, how can we go after the smaller suppliers? How can we make sure that they benefit from this as well? How can we ensure their onboarding process is much simpler, speedier? Suppliers don't want to have to worry about 2 months onboarding, that kind of thing. They want seamless, digital, instant access to these funds. And where the analysis comes in is when launching a program is actually quite difficult. There's a lot of programs out there which fail, just being honest. And why do they fail? It's because there hasn't been enough planning going into that. There hasn't been the right level of analysis of the supply chain to figure out who should we target, who should, and what priority, and what the terms discussions can we have. And I'm very cognizant of talking to both people in here kind of from the procurement organization. So, their priorities are going to be a little bit different from Treasury's. Their priorities typically are going to be more on the P&L side, and that's their KPIs. And so, where the data analysis comes in is we work with procurement to educate both procurement and their suppliers. What is the data set telling us about their supply chain? What is their suppliers' borrowing costs? What are their suppliers' own DSOs? And what do they pay their suppliers on, by the way? Because if they pay their suppliers 120 days, but they're making the procurement organization, pay in 30 days, well, actually there's some room there. So pre this sort of data analysis, we didn't have access to that information to be able to guide the procurement organization. And that's how supply chain finance has evolved, is marrying up the basics of the finance with the technology behind it to be able to target the right audience.
Freddie, I find it really interesting that tension between procurement, supply chain side of the business and the sort of treasury or finance side of the business. Because as you said, they have different objectives, different KPIs. But when it comes to your side of the fence, data must be pretty important. And particularly as you go down the tiers of the supply chain, I can only imagine it must be a challenge to bring everyone into a system where, it should be win-win for everyone. But you've got to have some pretty serious data on all the players in the system for them to be able to even participate and therefore benefit in the system, I imagine.
Yeah, it is. I mean, it's interesting when banks typically their target audience is treasury, at least historically, and attending procurement conferences like this is now a really important part of JP Morgan's strategy because we should be talking to procurement organization, and it happens so often where Treasury will come up with this great idea, this great working capital focused idea, and they haven't really brought procurement along for the ride. And so by the time we get there, we get to talk to procurement, they're not engaged, and so the whole thing's doomed to failure. But by starting off with procurement, we can talk to them about, okay, so your priorities are more on the P&L side. How can we take cost out of your supply chain? how can we leverage the data that we have on those suppliers? So we know that your key supplier's borrowing costs is at 3%. We're going to use that data, and we also know, by the way, that they already participate in other programs. Here's that data. How can that support your terms negotiations with that supplier? And it comes down to even deep dives on specific suppliers. So procurement managers, they can go into that annual contract negotiation, whenever it is with their supplier, and they can be armed with a wealth of data on that supplier that they didn't have. They know exactly what they're paying their own suppliers. They know exactly what their borrowing costs are, and they know whether they take early payment elsewhere. And that can be part of that negotiation to get the right outcome.
I find it really fascinating that taking the cost out, and I can only imagine that would help the conversation between the different parts internally, the different parts of a business. If a procurement or a supply chain professional can make the case that we're taking cost out of the system, that would help the internal conversation with the treasurer or the chief financial officer.
Yeah, it does come down to the KPIs, and you need to make sure that both procurement and treasury, well, mainly procurement really, because they're the key to launching it. They're the ones, so the tires on the ground, if you like, of the car. They need to have KPIs which aren't just focused on P&L. They have to have some working capital in there as well. But at the same time, they need to understand that, and moving away from supply chain for a moment, there's so many solutions out there which can benefit the cost out piece. And we were approached by a very large US retailer recently. They've had an SCF program in for a long time. They said, listen, how else can we take cost out of our supply chain? And we've done SCF, lots of people doing SCF, that's fine. What else can we do? And it came to their attention that their suppliers were taking loans out to cover the pre-shipment period supply chain. So, most people will have the post-invoice approval period wrapped up so they can cover the payment terms. How can we fund that pre-shipment cycle or even pre-invoice cycle? This retailer was intelligent enough to know that if their suppliers are taking out loans to cover that manufacturing period, it's costing them 4-5%, maybe higher, depending on the size of the supplier.
It'll end up costing them.
So their solution was twofold. A, they want to take cost out. So how can their suppliers get access to liquidity? How can they make sure they are supporting their suppliers? Because it's not just about taking cost out. They also want to have a robust supply chain without their key suppliers going under because of lack of cash flow. So that was one important piece. The other important piece was, can they actually get a piece of the pie? And it wasn't just about a revenue for them, but it was also, why are the banks or whoever it is was lending these suppliers money getting all the revenue from this? We want to support our suppliers. We can also get something out of this. We'll be very transparent. This isn't sort of a hidden rebate structure or something. It's very transparent. Listen, suppliers, almost like embedded finance. We can work with banks. We can guarantee some of this, by the way. So, the retailer can put up a guarantee, or there's different ways of structuring it. They can, have a tranche in it. So they have a revenue benefit, they have a cost out benefit, they have a working capital benefit, and the supplier, has all of those things as well. So this is what we're talking about with a win-win-win scenario. It's not just an arm wrestle between treasury and procurement anymore. There's solutions out there with the help of data that can make sure everyone benefits.
Now, Freddie, you mentioned a phrase on the call the other day called deep tier. And as someone who believes in trade and bringing more, say, particularly SMEs, smaller companies really in, is this what you're talking about here? Is this a way of allowing smaller companies, possibly in emerging markets, to get involved, to access, to sort of trade off the position of a bigger partner, bringing more people into the system?
Yeah, deep tiers tried. I don't think it's really got there yet. It's still one of those, just like a fusion power, and
I like it.
It's always going to be there in 30 years' time. But the one way of doing deep tier is through blockchain, and the previous panel was excited about blockchain as well. So maybe it is finally going to come up to its own. And the reason why you can make blockchain work is, to your point, you have the buyer in this case, which is a good rating. The banks like the risk, and under SCF it's very simple because it's direct risk on that buyer paying that tier 1 supplier. And this is particularly prominent in the Middle East. I was in Saudi a few weeks ago and being asked this very question. Their tier 1 suppliers are actually pretty well rated as well, so no one's worried about them. is actually the tier 2, tier 3, tier 4 suppliers. How can you support them? And this is what deep tier is trying to solve for. You've got the off taker, because, and let's say it's a enclosed project. Those are the easiest ones to do. Maybe you're building a power plant, maybe you're building a stadium. So you know the buyer's going to pay, or you know that they're planning to pay. How can you take that promise to pay down the tiers? And this is where blockchain can tokenize it. And so you have that ability to move that sort of promise to pay down the chain. Is there a simpler way of doing it? Well, possibly in ITFA, International Trading Forfeiting Association, which is a fantastic body. There's a working group out there right now which is trying to figure out simpler ways to do it. Because although blockchain is ready, the technologies are there, it does require banks to invest in that specific part of it, and it's been difficult to scale. I think the other solution which is already there is, and it can work for the pre-shipment point as well, it's that data, again, the data analysis point. So traditional bank lending has been focused on the balance sheet. It's historic data, which is fine, but it's probably more fine for larger corporates which have several years they can go through. For smaller companies or newer companies, they haven't got that data. They haven't got that sort of history to look at. So what can we do instead? Well, we're looking at transactional flows between the buyer and the seller, because what you ideally want to move from is away from a balance sheet lend and more towards a sort of performance lend. Again, the off taker. You've got a big company which everyone likes, but you don't know the history of the performance between the buyer and the supplier. So you want to try to figure out historically, over the last couple of years, whatever it is, has the supplier performed their contractual obligations to that buyer, yes or no? And it's that kind of data which you can then utilize to then lend to that supplier on. So it's not a traditional balance sheet lend, and it's also doesn't require credit opposite to do a deep dive, which again takes time and effort and resource, and it's slow and clunky. This allows you to scale up things like deep tier and pre-ship, with which you need to be able to do to be able to make these things work.
Yeah. In the last couple of minutes or so, I just want to ask you about, again, thinking about people in the room, what other strategies should they be thinking about, or can they be thinking about to improve liquidity in their supply chain finance? You've only got a couple of minutes, but any other strategies you think people here in the room should be thinking about?
The other thing which we haven't talked about yet is the UK Electronic Digital Negotiation Act. Sorry, words out. And this is a fantastic piece of legislation because it finally allows things like prom notes and bills of exchange to be used at scale.
Right.
And to anyone in this audience who wants to combine kind of risk mitigation, or their suppliers want that risk mitigation, but they also want to negotiate longer terms potentially. The supplier's asking for a promise to pay. Up till now, you needed to rely on letters of credit, which are expensive, and they are a bit clunky. With these instruments, and it's fine under English law, so that's the caveat right now. English law is fine, but not every jurisdiction is quite caught up with that yet. But with these instruments, you can, because they're digital, you can issue them at volume. So in theory, they could take over from SCF one day, but they're a little bit more robust than SCF because it's not just open account. So I think that's a really fantastic thing to look at. And the other benefit for a procurement organization is you don't need necessarily to change the terms in your underlying contract with the supplier. So let's say your underlying contract with the supplier says 60 days. You don't particularly want to mess around with that. Maybe it's an energy contract and actually you've locked in really great energy prices from a couple of years ago. No way you want to open that one up. So what can you do instead? Well, you can start issuing prom notes out, or bills of exchange the other way, and that will have a different tenor on it. And again, you can do it at volume now through the digitization. The supply that your underlying contract hasn't changed, so that still sits there with the original terms, but you have a different contract sitting above it.
Fantastic. Freddie, unfortunately, we've run out of time, but what I find fascinating is that there will be traditional banking and traditional finance, but all of these innovations in the supply chain finance area, it does feel to me like bringing more people in, allowing more trade to happen, deep tier, further suppliers in the supply chain, and I find that really, really, really positive. We have run out of time, but I don't want to burden Freddie, but do feel free to keep talking to him outside. Lunch break is coming up soon, coffee break. Do feel free to get in touch with Freddie here, but please join me in thanking Freddie for a great discussion.
Thanks, Jim.
Thanks, mate.
Thank you.
Great.